Okay.
I show right on 12:30 right now, correct?
Yes. Confirmed.
Let's start in about 45 seconds.
Sounds good. All right. Okay, I'm going to start the broadcast in 5, 4, 3, 2.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the Winter 2017 Linneman Associates Capital Markets webinar presented by Linneman Associates and Valuate Software, a product of real estate financial modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, producer of Valuate Software and provider of financial analysis tools and training to the commercial real estate business since 2009. We're very pleased today to have an insightful program which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. Today we're using the GoToWebinar platform, and I would like to address just a couple of housekeeping items before we get started to make sure everyone is comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that is by design, and will remain the case throughout the entire webinar. If you are attending via computer, please now take just a moment to familiarize or reacquaint yourself with the small floating control panel box which will be on the right-hand side of your screen. We will be showing the slides in the larger viewer window, which is on the left-hand side of your screen, but if you would like to download the slides, find the Handouts section of the control panel and click on the file name and it will automatically download. You do not need to have the slides up during the presentation because we'll show them in the viewer window, but you're welcome to keep them for your future reference. We have reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but please do feel free to submit your questions at any time during the presentation by clicking in the Questions field of the control panel box, typing in your question, and making sure to click the Send button. If at any point during the webinar you get disconnected, simply reconnect by clicking on the link you used to connect initially, or dial back in on the same line you used to initially dial in. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you.
Thank you very much, Bruce. Bruce, for those who don't know, is a great friend and a former student. It was very helpful in later editions of the book. So terrific to have you with us, Bruce. And I don't know about where you're at, but I happen to be in New York today for the call. And you say the winter program, if every day in winter could be like this, I'm a happy man. It's quite nice actually for the last day of February here. So let's go to the first chart and see where some things stand. Economic Policy Uncertainty Index. You see the red and marked as the average over this period. A lot of volatility. Always have a lot of volatility around elections and shortly thereafter, but bouncing around normal. We're away from this period of 2008 through 2014 where you saw there was very high economic policy uncertainty. We're still got a lot of noise and a lot of uncertainty. It's not to say there's no uncertainty, it's just to say that it's around normal with a lot of volatility. And I think that's one of the reasons the economy has continued on through the election, through all the stuff that's going on, which is uncertainty is down from these crippling heights we had for about 6 years. Go to the next chart and you'll see actual GDP in the blue and the long-term trend in the red. I've said this before, I show a particular time period long-term trend, but I could take almost any period prior to 2007 as the long-term trend and you'd have basically the same picture. Anytime throughout this discussion today when I say real, all I'm referring to is we've adjusted for inflation in the usual way. What you'll see if you look at the blue first is that real GDP has made a very nice recovery from the drop of 2009. It has continued upward now. We're in our 7th year of upward growth, growing pretty steadily. If you look at the line, it's a pretty straight line. It's only growing at about 2.1% per annum at that rate, which is about 80 basis points below the long-term average. Just to put that in context quickly, and I'll do very quick math to drive home the point, if you think of about 90 basis points of population growth and 2% of productivity growth a year, and we're not doing that. We're doing about 90 basis points of population growth and only about 120 basis points of productivity growth a year over this recovery. There's been no bounce back, if you will. That 80 basis point shortfall in any one year is rounding error. But when you start accumulating that, it adds up. And it really amounts to a 40% reduction in normal productivity growth. I did some math the other day, and it says the difference between a 2% per annum productivity growth and a 1% per annum productivity growth is that a 2% productivity growth doubles the real living standards of people every 36 years and quadruples in 72 years. So think of a lifetime, if you will. Whereas a 1% productivity growth doubles in 72 years. So it's a real number. If you look at the red, you'll see that while we have gotten growth, we're the richest large economy in history, I'd like to point out, in per capita and in almost every way you want to measure it, we have a huge shortfall, the $3 trillion, $3.1 trillion shortfall versus trend. Every time since 1800, when this has gotten above trend or below trend, it has always reverted. This is one of the longest diversions below trend. The Great Depression was a severe diversion below trend and then caught up. We had boom eventually after. But this is a very long deviation below, and it captures the problem. And the real problem is about half of that gap is due to housing, single-family housing in particular, and the knock-on effects like mortgage origination, etc., that go with single-family housing. If single-family housing were having a normal recovery through this recovery, you would have closed just on that alone the gap by about $1.5 trillion, something in that range. So the fact that single-family is lagged and is lagged because people don't have the down payment. Yes, they have credit issues. Yes, they have to fill out the forms. But the real issue, all the research shows, all observation shows, is you need down payment. The zero interest rate policy wiped out savings on 6 months to 2-year CDs and saving accounts, checking accounts. That's how real people save for down payment. It's how real senior citizens with $300,000, $400,000, $500,000 of net worth save. And it wiped it out. It was effectively a policy that put 100% tax de facto on those kind of savings. And those people who are lower, middle income people have not had the resources to do down payments or to get the resources from their parents or grandparents from their CDs to make the down payment. So instead of booming back like it has every other time and closing the gap, single-family housing is lagged. Go to the next chart, quick look couple looks at the labor market. The number of people employed, you can see, is up. We're at an all-time high. Employment in the United States, it's up about 12 million from the bottom, but it's only up 2.2 million from the previous peak in 2008. I think that's noteworthy because it says that while we've added jobs, most of the jobs we added were just getting people back to work as opposed to growth. If you think about since 2008, we've added roughly 20 million people, and only 2.2 million of them got jobs. You can see that there's a lot of slack in that regard. So while it's great to have employment, the employment market looks good, there's a lot of slack. People have dropped out of the labor force, particularly males have dropped out of the labor force for a variety of reasons. So good that we're adding jobs. We're adding jobs at about 2.1 million a year. That's a quite good pace. It's very healthy. So I feel good about that. There's still a lot of runway there in the labor market. Go to the next, the civilian unemployment rate. You see in the blue for everyone. And it's reverted back down towards the lower bound that it's ever gotten. It is not the bottom it's ever gotten, but it's quite recovered. One of the things that makes that a little deceiving is what I just said, though. We have a disproportionately high labor force dropout rate for this point in a cycle. We've had this high of ratios before, but rarely at this point in a cycle. Usually at this point in a cycle, you've attracted a lot of those people back in. And again, as I say, males in particular have not been attracted back in. If you look at the red, though, there is a good indicator. That's teen unemployment, way down. And the reason I say it's good is an indicator of the labor market. The first to go are teens. You can see how quickly it shot up. The last to come back are teens. So the fact that teen unemployment is back down near a low says at the margin there's a lot of employment demand out there. Go to the next. It's the employment to population of employable age ratio. It is improving. You see it's risen. It's risen back actually to its mean, but the mean is a bit misleading because in the early part of this chart you did not have high female labor force participation, and that's why it was low. When you get to the era where there was high female labor force participation, by those standards it's quite low. And what's driving it now, as I say, is males, work-age males not being in. And in fact, in the next Linneman letter, we have a piece discussing this in more detail. So I'll let you look forward to that to get more insight. Go to the next. We look at labor markets in different metropolitan areas. You see the U.S. And the 10 largest metropolitan areas in the United States. These are not the cities of, but rather the metropolitan area of. You see the unemployment rates. Chicago is the weakest in terms of unemployment, though. If you think about 6% is generally considered pretty good. Everywhere is pretty good, and you have a couple of places like Dallas and D.C. and Boston and San Francisco being very good. Year over year change in employment percentage change, 1.6 at the United States. We're adding less than 1% to the population a year. We're adding about 85 basis points a year to the population, so we're growing employment almost at twice the rate we're growing the population. Obviously in the long term that's not sustainable, but because of the slack that's out there, it is sustainable for a good while. You can see again Chicago is the laggard. And Houston is 0.5%. I think that's kind of a staggering number if you think about it. Its main industry collapsed, and yet Houston has such good growth fundamentals that it could offset all the jobs lost in its main sector and still register year over year a 0.5% growth. And moving forward, you'll see Houston come back to the head of the class in this over the next 5 years. Go Go to the next chart, you'll see weekly initial unemployment claims. These are people who went in, filed for unemployment. This is a real number. It's not a survey, and it's 1 week old data. The red marks the average. Anything below 300 is a quite strong labor market from a demand point of view. There are positions available for people. It's the lowest it's been since 1973. And that was, if you think about it, almost 45 years ago. And we had a population that was 100 million or so smaller than today. And we had the same number of unemployment claims. So you get a sense that it's quite strong. When this shoots up quite rapidly for several months and gets above 300,000 a week for a sustained month or two, watch out. But right now, great fundamentals in the labor market showing. Go to the next. Go to the capital market side. You'll see that what you know is the 10-year Treasury has been bouncing around and it's risen, but you see that by a historic standard, this recent post-election rise is nothing. It's still extremely low by historic standards. It's only around the rate of inflation, and the short rate is still very close to zero, an unprecedented low for an unprecedented amount of time. That short rate is a totally manipulated market rate, or interest rate. It has distorted the capital markets. It's distorted the long bond, as has QE, and the Fed maintaining its portfolio. It makes it very tough to know what one should do still. One of the things that there's very little penalty to holding cash, so we have about $2.1 trillion more held in cash than is historic norm by trend. And cash is not a very productive asset. If rates were higher, people would be getting higher returns on their investments, more akin to what they're used to for the risk they're taking. There'd be more risk-taking activity. I think a lot of people are afraid of taking risk only to find out they had been fooled to do it at too low a rate of return. You add to that these low rates have robbed savers. And if you go to the next chart, this is the real income received from all forms of interest payments by savers in the United States economy. It peaked in 2007. Since 2007, the total amount of debt in the economy has actually risen slightly. And yet the interest payments received have fallen dramatically. If interest rates had stayed roughly where they were in 2007, it would have amounted to $2.3 trillion more in interest payments received. And think of, 10% of that flowing into single-family housing down payments, 5% of that flowing into single-family home down payments, and many other things. That is to say, this low interest rate policy has certainly helped borrowers and helped many of them get well, but it's killed savers, particularly those who saved short and safe, and think of 6 months to 2-year CDs. And as I say, that's a primary source for single-family housing down payments, or 6 months to 2-year CDs. If you put 100% tax de facto on the main source of down payments for single-family housing, it's not surprising you're going to see a lot lower housing demand recovery. Go to the next chart. I've normalized auto sales in the red and and the housing starts, including single and multi, in the blue. You can see that normally housing a bit goes up more than auto and down more than auto in its peaks and troughs, but generally they track pretty closely. You'll see they both fell. Housing fell much more than did auto. That's because it went up a bit more beforehand and stayed down. And for the first time in this chart, does not go back to where auto was. All the other times they quickly got back on top of one another. And that's this lack of down payment. People say, well, young people don't want to own anymore. It's not consistent with surveys people have done. Newspapers like to write that, but it's just not consistent with the data. And by the way, this is not the first time you've seen collapses. And young people got over it every time in the past. And the reason they got over it was they were able to come up with down payments. This time, the low interest rate policy, which is absolutely unique, has made that very difficult to impossible. Go to the next chart. Moving broader, consumer confidence index was for about a year right about average, just slightly above, and we've had a 2-month post-election pop. It's not revealing itself much so far in retail sales activity, a little bit, but not massive. And it'll be interesting to see if this is the beginning of the next period of 2 to 4 years of above average consumer confidence. If it is, you tend to eventually get excesses brought on by that excessive consumer confidence that ultimately lead to a recession. You rarely, if ever, get a recession if consumer confidence stays around average. You can't build up the excesses, and the most notable excesses that occur are in autos and single-family housing. We know there's no excess in single-family housing, and we know that there is almost no excess in autos. So this looks good. It means that there seems to be a lot of runway for the economy in terms of confidence and things getting better. Going to the next chart, a quick view of the government, federal government. Receipts as a percent of GDP in the blue. Spending on everything by the federal government in the red. By the way, for those of you who like data, if you go back 50 years, 75% of what was spent by the federal government was discretionary, 25% was locked in so-called entitlements. Today, roughly 75% of what the government spends is locked in so-called entitlements, and 25% is discretionary. It's a huge swing over that time period. You can see that spending was brought down by the various moratorium that were put on spending. It's creeping back up as a percent of GDP, and revenues came back as people got jobs, stock markets up, etc. The deficit is in a sustainable position. That's the green line. Not great, but sustainable. What do I mean by that? You may love it, you may hate it, but if the deficit's about 3% a year and the economy grows at 3% a year, you can support it. We've got a deficit growing at about 4% a year and an economy growing at about 2% a year. So it's not completely sustainable, but it's not crazy. Let's go next and let's turn to commercial real estate markets. You'll see multifamily mortgages in the blue and commercial mortgages outstanding in the red. Multifamily, if you look at it quick, much more stable. It did not drop during the crisis. It flattened during the crisis and has been rising. It's the main reason that multifamily cap rates have stayed quite low, is follow the capital flows, and the capital flows, mostly mortgages, are flowing into this and supporting prices. As I think I've mentioned in the past, our research shows that cap rates are pretty much insensitive to interest rates. They're highly sensitive to movements in mortgage flows. We've written about that in Linneman letter a lot about why that's the case, but watch the capital flows. If you look at the red dropped dramatically as you went through the crisis and its aftermath. That crushed prices. You take capital out of a capital-intensive industry, it crushes values. What's happened since is you can see that the red has risen quite dramatically and is rising quite dramatically, rising more dramatically than multifamily. It's why pricing for commercial real estate has so dramatically improved. And in fact, the recent movement in interest rates caused a bit of a bid-ask gap, but it did not erode pricing, nor did the interest rate movement of several years ago either, and that's because capital was flowing. So watch capital far more than interest rates in terms of cap rates. Watch interest rates in terms of your balance sheet, obviously. Go to the next. It's NCREIF's cap rate estimate based on transactions that occurred. And what we're showing is the spread over 10-year treasuries. If you go back in the 80s, it was about tax breaks. That's why the spread was negative. It wasn't about real estate. You then make it about real estate by about 1990. And you can see by standards since about 1990, the spread today is high. We know cap rates are quite low. They're about the same level they were in 2007. Those are the two lowest cap rate periods we've had. But the spread is high. And in fact, this is very different than if you go back to 2007 on this chart, you'll see that we know cap rates were low, but if you notice the spreads were also very low. Today what you have is the same cap rates, but the spreads are high. This is the dilemma, which is low cap rates say be careful and make it hard to carry your debt service if they're very low. And yet high spreads tend to be associated with good buying periods. And my own view is if you can find spread on quality and you can lock in that spread for 8, 10 years with fixed rate financing that allows you to have interest coverage, so-called positive leverage, it's a good situation. So spread looks like a bargain in most places, and yet cap rates don't look like a bargain. So you have to kind of play it as a two-part game. Get a high enough cap rate that when you capture the spreads, you can cover the cheap debt. Go to the next, real public market commercial real estate values. They've moved back up. You see the high, the low markers in the blue and the red being the average. So since about 2011, we've been above average on commercial real estate in the public market, but well off its peak still. If you go to the next chart, you'll see private markets, same thing, adjusted for inflation, and you'll see we're at new peaks. And in fact, you see that it continues to rise. This says the private real estate market and the public real estate market have a bit of a disconnect. That's the discount to NAV that currently exists. Historically, public has moved more to private over the long term. We'll see. But pricing is not cheap, and yet spreads are fairly large. Go to the next chart, and we'll look at retail values based on transactions. Most of the volatility in this comes from what was sold in that particular period. Again, high, low, average, adjusting for inflation. We're well up from the bottom, a lot of volatility. I think that more reflects what's sold than true volatility. And we're above average. We're probably above average by about 10% right now. That is to say the low cap rate relative to the spread is generating that value, but you also have pretty good cash flows. Go to the next, what's the retail market doing? If you look, construction, well below average in dollars. Adjusting for inflation, there's not much being built. Yes, we're building a bit more, mostly add-ons, tear-downs of and reconfiguration of space, not much new space. So that's a strong sector. Go to the next, real retail rent, still bumping along after you adjust for inflation near its bottom, not at bottom, but still not robust. Obviously, we know this is a tale of good centers and bad centers. Some of the good centers doing much better than this picture would suggest, but bad centers kind of continue a downward trend. Go to the next, which is multifamily. Again, you'll see the real estate values, a lot of the volatility again on what particularly is being sold, well above average though. probably around an all-time peak and probably 25 to 35% above its historic average. So I think there's something to be said that that sector feels a little pricey. But again, if you can get spread and lock it in for 10 years, it's pretty attractive at a decent cap rate. Go to the next, multifamily construction in units is about 10% above historic average. In dollars, it's way above historic average. And what's notable here is we're basically at the same dollars as 2005, 6, 7 today, adjusting for inflation on the same units, which is to say everybody's building high quality units. In the old days, you used to build lower quality multifamily. Everything today is being built higher quality. It's arguable even building higher quality rental than then, because in 6 and 7 there were a fair number of them that were condos, so they were bigger and even higher finish units than the rental. Today mostly it's all rental. So a lot of construction activity. Go to the next and you look at rent, adjusting for inflation. We're at peak levels, well above average, well above the last cycle that we're moving. A lot of that is just plain fundamentals. Some of it is higher quality units than in the past are being rented, which skews it upwards over time, but feels a little peaky. Go to the next. Same exercise for office values. Office values moving 5% maybe above average, you know, with the volatility of what's being sold, well up off the bottom, not near the highs of 2007, a la equity office or some of the transactions of that nature. But let's say 5–10% above average in real terms. Go to the next. Office construction has moved well above average, and in fact in real terms we're below where we were in 2000, but we're above where we were in 2006 and 7. So in dollars being spent. Go to the next. Class A office rents for CBD in real terms above average, not at their peak, moving upwards, showing pretty good strength. If you go to the suburbs, the next chart, you'll see that they have bottomed. The suburbs have not disappeared as some people thought they would, but they have not fully recovered. This is again a bit of an exercise like retail of them that got and them that don't got. The stronger suburban properties are doing pretty well, and the weak suburban properties just continue to plummet. Go to the next on hotel. You'll see hotel values not too much above average. There was a peak about 2 years ago, and since then kind of bouncing around a little bit above average, but within that range. Go to the next. Hotel construction is above average, nowhere near where it was at in 2006, 7, and 8. It's actually starting to trail off. New York City is where most of this construction is occurring. Vegas is where a lot of it was occurring last time. New York City is where it's occurring this time. That's expensive construction on a per room basis. If you took New York out, this would look much healthier. Go to the next. Real hotel RevPAR, you're at a new peak. You're at an all-time peak, way above average, great strength there. It's hard to believe with above average construction that RevPAR hasn't going to get pushed down, especially as the economy weakens over time. Go to the last sector. We'll do the same 3 charts for industrial. You'll see that its value is around all-time peaks, adjusting for inflation, pretty much back to where it was in early 2007. If you go to the next, you'll see that there's much more construction going on than there was in 2007 or the previous peaks. So a lot of construction going on. There is very good demand, but a lot of construction going on, and that construction is maybe starting to pull back a little bit. A lot of the construction is for new internet-driven kind of platforms. If you go to the real industrial rent slide, you'll see that it's interesting. Values are very high. Construction is very high. Rents, adjusting for inflation, nothing special. Right about average. They've made a very nice recovery, but nothing spectacular. Obviously, there are special markets, but on a total basis, nothing spectacular. So most of it is occurring there on the belief that there's going to be increased demand, particularly from internet sales that are occurring. One interesting thing, and we wrote about it I think in the last Linneman letter, is that it's very easy to say people like to shop from home and they like the convenience and the new generation. It's all really great except for one thing, which is internet retail doesn't make money on anything that has to be delivered physically. They make money if it gets delivered digitally but not physically. So you can look at Amazon, for example, which sells at like 190 multiple, versus Walmart, which sells at a 16 multiple. And in fact, almost all of Amazon's profitability, as far as one can tell, comes from cloud service and from membership sales of Prime, not retailing per se, but memberships, and also from service fees for procurement for third-party vendors. They don't really make money on their huge amount of internet sales. It's kind of stunning. And if you eventually said, if they got a 16 multiple, that is, the capital market says, show me what you got, you would have a very different world. They'd have to generate profits on their retail sales. They'd have to raise their prices dramatically, and would people still want, quote, the convenience of shopping? The jury is still out on all that. It's all fine and well, but the jury is still out. Let me just end with kind of 3 charts to make you think a little bit. We get asked, are there cracks appearing in the real estate capital, real estate investment markets? There appear to be fewer bidders out there than would have been the case a year or 2 years ago. There appear to be wider bid-ask spreads than 6 months ago. The last 4 months of last year and the first 2 months of this year appeared to have generated bigger bid-ask spreads. Interestingly, transactions that are occurring at about the same pricing, but it's with fewer bidders and a bigger bid-ask spread, meaning probably not as much volume occurring. There's been a bit of an increase in broken deals, which again is consistent with wider bid-ask spreads and fewer backup bidders, but it's not been a complete collapse. And in the last quarter and into this year, there's been a pullback of development loans by banks. Banks have pulled back more on development loans than non-bank banks have stepped up. Non-bank banks are doing more, but not enough to offset what banks are pulling out as their capital standards. I'm not sure there's so much cracks as some variant of discipline setting in, saying, I got to get paid for risk. Crack would mean it falls apart from here. Discipline means we could maintain this for a while. Go to the next is just sort of a fun chart. A study was done of federal mandate restrictions. You must do this, you mustn't do that, you have to do this, you can't do that, etc. And actually, this is the number of new restrictions introduced per annum. The first says 1976 to 1980. It's supposed to say 1970 to 1980. It's the decade. So it includes Nixon, Ford, and Carter. During that decade, not 76, but from 70 to 80, from that decade, 25,000 new restrictions were put on by the federal government a year. During the Reagan administration's 8 years, it was 6,200, a dramatic reduction. And in fact, for the first 5 years of the Reagan administration, there was 0. That is to say, the last 3 years had enough to bring it up to 6,200 200 per annum, but it really was 3 years of zero, and 5 years of zero, and then 3 years of a fair number. Bush Senior's administration in 4 years was exactly back to the pattern of the 70s with 25,000 new restrictions per year. Bill Clinton's administration averaged 6,200, almost exactly the same number per annum as the Reagan administration, and it was interesting, similar to the Reagan administration, it was made up of 4 years with a fair number of restrictions in the first 4 years. In the last 4 years, there was actually a modest reduction per annum. So it averaged out to 6,200. Bush Jr. became president during his term. It was 22,000 again, pretty much back to the 70s in Bush Senior era, and the Obama administration 8 years averaged 17,000. I've rounded all this just to make it clear. The point is that's a lot of new things to adjust to. The Reagan and Clinton do prove that you don't need that many, and when you don't do that many, the economy actually performed pretty well. And in fact, it also shows that zero can be achieved, 5 years under Reagan and 4 years under Clinton. So bear that in mind as you think about the regulatory discussion. And I'll end on my canaries. All my canaries are still alive and healthy in terms of pay-in-kind debt running rampant. You don't just see it in corporate deals. You do see, as we saw earlier in the chart, a lot of mortgage growth in the commercial real estate sector, so a couple of the canaries have bit the dust. There's been speculative development boom, as you saw. There's been a lot of construction. Hotels by definition and apartments by definition are speculative. You are seeing some speculative office has occurred and a lot of speculative warehouse. So we've killed some of my canaries there. 3 of them are dead. Mezz, first getting more aggressive. I actually had 3 canaries dead on this, but the first has gotten less aggressive. It turned out one of them wasn't dead, was just sleeping. So we're back to only 2 canaries dead there. Mezz replacing equity. Yes, there are mezz out there, but they're not going up to the 95% level of the capital stack at mezz pricing. You've got spreads are narrowing and LTVs are rising. We only have 2 dead there. Again, we had 3 dead, but 1 was only sleeping. Still under decent control. Spreads on loans are not narrowing much, and LTVs are holding constant. Record buyout deals, overcoming natural barriers, psychological barriers. 3 dead canaries. I almost had a 4th one dead if the Unilever deal would have gone through, or if it does go through. And empty space being worth more than full space. In real estate, we've got a couple dead canaries. That is, people believe that I can fill it and do spectacular with the empty space without any risk premium. All told, still have a lot of canaries alive, and in fact a couple that I thought were dead came back to life. Looks like we've got pretty good strength moving forward into 17 in the economy, Bruce, and with that I'll end.
Okay, great. Thank you so much, Peter. Yeah, you know, we have a lot of questions coming through, and the one most commonly asked is, obviously things are good right now, and it's going to start to correct at some point. And what do you think is going to be the reason for the next correction? Every one of the major last 4 or 5 corrections have had a different different primary cause. Too much capital, too little capital, perverse incentives to develop. What do you think is going to be the main driver this time around?
Well, first let me say, I think we have an odd situation because usually at this point in a cycle, in a recovery, the single-family housing sector is operating well above average. And in this cycle, it's still operating well below average. And that's a big sector. And that is a big stabilizer, the fact that it's below average instead of above average, because that's a big ticket item that can have excess with. In other words, imagine we're buying bubble gum excessively. that matters, but it's not a big ticket item, and it's easy to change. When you start doing housing, it's a big ticket item, and it takes a while to change. We don't have that, and that's one of the best factors in it lasting. What do I think will make it end? Something we haven't thought of yet will make it end. We're going to get over exuberant. I don't think we're going to get over exuberant for another couple of years, though. And the Fed has an amazing propensity to do the wrong things all the time. And so they've now created a highly artificial situation. They created an artificial house of cards. And to get back to the real world, they could hurt a lot of people. They're going to have to hurt a lot of people to get back to the real world. And if those real people overreact, you could get a knock-on effect. So I'd say watch the Fed, watch consumer confidence, but right now things look good and interest rates should dramatically go up, but they've got to do it with care because they've done it with such lack of care heretofore.
Okay, great. We also have several folks asking about multifamily, if there's going to be a sort of a new normal for multifamily that's going to allow for this continued multifamily development, significant multifamily development, and might impact single-family home construction. What are your thoughts on that?
I'm very bullish on multifamily as an investment. I like the idea of buying at a 5 to 6.5 cap, a decent quality property, putting on a mortgage that takes advantage of the abnormal spread. And okay, even if income drops 10%, you still easily cover and you work it through and you ride value. I like multifamily in general. I don't like it at a 2 cap or a 3 cap, but I generally like it. Having said that, all good things will eventually come to an end. We have a cumulative shortfall of multifamily units of somewhere between 500,000 and 800,000. If we overproduce versus norm by 50,000 units a year or 100,000 units a year, we'll eat into that pretty quickly. We'll eat into that dramatically in certain markets and sub-markets because everything gets built in the same places. Everybody has the same idea. And so the danger in multifamily is not so much in the aggregate over the next couple of years, it's more in the micro, which is everybody wants to build downtown Nashville. Everybody wants to build, downtown Seattle, or name the markets. This is not to say there isn't more demand there than there's ever been before. It's a question of how much demand. So I think you have pockets of overbuilding and identifiable overbuilding in multifamily. Longer term, multifamily faces the challenge that we'll see, time will tell. I think the millennials are going to want to do the same thing as every preceding generation as they get a down payment and as they have children of school age, which is they're going to have to move, they're going to disproportionately move to the suburbs, and they're going to disproportionately want yards, and they're going to want disproportionately not to have neighbors complaining about how loud their kids are through the walls. And therefore single-family housing goes a long way that way, and the suburbs go along that way because of the schools. So I live in the center city. I've lived in the center city all my life. I've lived in an apartment structure all my life. This is not against the concept. It's a matter of the reality. Children change lives in very dramatic and fairly predictable ways, and millennials are about to see their lives start changing. I made the joke, I think at a ULI meeting a year or so ago, that baby boom males said we'd never cut our hair, and a lot of us had our wish come true. It all fell out, so we don't have to cut it. nature has its way. And so I caution my multifamily clients not to go hide, but to have some sense of realism, to understand today's not the only day, that things, you want to be able to succeed over the next 10 years, even if things soften out and revert a bit.
On the millennials topic, we have one participant who is of that generation, and they're considering.
I assume you're talking about me.
This anonymous individual is considering being a first-time home buyer in the Boston area. And if you were to put yourself in their shoes, would you buy at this point in the cycle, or given how interest rates are likely to move over the next few years, or would you not buy?
You know, it's interesting. I answered this question pretty steadily throughout my career the same way. I wrote on this topic about 25 years ago, published a couple of papers on it. I think it's pretty simple. You should not be looking at your home as an investment. You should be looking at your home as a place to live, to raise your family. If you don't look at your automobile as an investment. You don't look at your shirt as an investment. You don't look at your going to a baseball game an investment. You look at it as, can I afford it? And is this what I want to do with my money? And am I comfortable doing it? You don't want to overreach, but is this what you want to do? So my advice is, at almost every point in the cycle, it's a good time to buy if it's the right time for you and your family to have that home and you can afford it. And if that's the place you want to live, if that's the place you want your kids to go to school, and that's the housing environment you want them to be, that you may make some money by doing it, that's great, or that you may lose a little money, that's fine. You don't make money by going watching your favorite sports team play. You don't make money by going to a concert. You do it because you enjoy it and it's the right thing for you. And that's always been my view on homes, that yes, you're putting up a lot of money, but it's not an investment per se. It's the amount of money you have to almost put in abeyance. And you may lose some of it and you may win some on it, but you have to put it in abeyance in order to give your family and you the lifestyle that you desire. And the other thing the research shows is, if you only think you're going to live in the home you're purchasing for less than 5 years, the transactions costs just make it irrelevant trying to be an owner. Now you may end up living there for 50 years, but if you think you're only going to live there for 3, 4, 5 years, don't own. The transaction costs eat you up. But if you're going to live there 5 to 10 years, or you think you're going to live there for 5 to 10 years, it's the right place for you, you can afford it, do it. And maybe you make money and maybe you lose money. Nobody knows from now what values of anything are going to be 10 years from now. So so what I would say to the young person is what I've said to a lot. Is it where you want to live? Is it the right place for you and your kids? Can you afford it? If so, do it. If not, don't.
Great, thank you. We have also several participants asking about rates, specifically in one question about the impending wave of CMBS maturities and mortgage maturities in general, and whether you see 2017 or 2018 as being a potential trouble spot for refinancing given higher rates and the values.
You will see more trouble than the past couple of years only because there's more coming due. I don't think the rate of trouble will be higher so much as if I apply the same rate to more cases, you'll see more cases of it. 2017 is a big, and put it differently, the class of 2007 was the largest CMBS class ever, and therefore 10 years later is the largest coming due ever. I don't think that the rate of problems among those will be so staggering, but there's just a lot of them by historic standards. So in that sense, yes. On the other hand, if you go back and you think about the property value charts we were looking at, mostly property values in real terms are above average, and in most of the cases, property values in real terms are higher today than they were in 2007 when that loan was taken out. Now that's in real terms, and that means you've got 10 years of what, 2% inflation. So in nominal, if the prices are the same in real terms today as they were then, nominally they're 20% higher today. So in an LTV sense, you probably have decent cushion in general. And if you think about it from a coverage point of view, today's lower interest rates make even difficult coverage ratios much more manageable, even if income didn't grow much from 2007 to today. Go back to the rent charts we looked at. Even if the rent has not grown, the lower interest rates give you coverage. So the combination in aggregate is loan to value and low interest rates are not going to trigger a lot, but you do have more of the assets that happen to be losing suburban malls, suburban strip centers that happen to be losing suburban office properties. Simply because it's a real big class. You give me a big class, you got more losers in a big class than a small class. And so you're just going to have a bigger class of losers. In a fundamental sense, it's about the properties, though, not the capital market. The reason I say that is, even though CMBS will be nowhere near in 2017 enough to finance all the loans coming due from CMBS, from 2007, bank money available is stunning. You saw the mortgage charts. Bank money, there's stunning amounts of availability if a property merits it. So what you really have is a bunch of properties that 10 years ago, right or wrong, people thought everything would be hunky-dory in 10 years. They had a pro forma where rent was going to grow 2% a year, and NOI was going to grow 2% a year, and occupancy was going to stay at 94%. And in fact, that property is at 71% occupancy, and rents have fallen in that property, even though the aggregate of the entire nation has done quite well. So you've just got more cases of more problems. It's not a capital market problem, it's a property problem that just happened to have a big class coming due. Capital will solve it easily, but capital's not going to get rid of the fact that a property that was supposed to be 95% leased is now 70% leased. Capital can't solve that.
Great. Thank you very much, Peter. Unfortunately, we're not going to be able to get to all of the questions that have been submitted by participants. I just want to make sure that everybody is aware, however, that this presentation, it's really just a digest of what is covered in greater detail in the Linneman letter, which is a quarterly hard copy subscription from Linneman Associates. And more information can be found on that at the Linneman Associates website. Also on the website are a free 50-part audio interview series with Peter on the real estate business and capital markets, and a link to a video interview series that Peter did with BizNow Media. And the website is what's shown here, linnemanassociates.com. Thank you to everybody for joining today, and we hope to see you back next quarter.
Thank you very much, everyone.